Let's start the second part of the real option analysis lecture series. In this part, we will be focusing on the option pricing and option pricing models, a simplified introduction of the both option and option pricing model. I'll start with the basic introduction to the simple terminologies of the option pricing and explaining to you the different types of option, that is call option and put option. I'll discuss the characteristics of call option and put option, and later on I will discuss with you the option pricing formula, and that I will discuss the Blackstone-Scholes option pricing model, its characteristics, its a solved example, its limitations, and the factors which are impacting on the value of call option and put option. Starting with the basic terminologies, derivative instruments are the financial instruments with a value stemming from changes in the value of some other assets. And the examples include options, warrants, futures, and swaps, etc. of the derivative instruments. On the other hand, the option contracts are the rights to buy or sell a given amount or value of particular asset at a fixed price until a given expiration date or until at a specified price during a specified period of time. Among the types of these options include call option. Call option is the right to buy a security at a specified price within a specified time. Put option, the right to sell a security at a specified price with a specified time. Option premium, on the other hand, is the price paid for the option above the price of underlying security. Intrinsic value is the difference between the strike price and the stock price. In terms of call option, intrinsic value of an in-the-money calls is the amount by which the stock price exceeds the striking price. The intrinsic value would be zero when call is out of the money. Whereas the trying premium is the value of option above the intrinsic value. Continuing on the defining the terminologies, the exercise price is the price at which the holder can buy or sell the underlying stock, sometimes also referred to as the strike price. Then expiration date, the date on or before which the holder can buy or sell the underlying stock. There could be two types of options, American options or European options. American option is an option that can be exercised on or before the expiration date. European option can be exercised only on the expiration date. All options usually act like European options because you make more money if you sell the option before expiration or versus exercising it. After understanding the basic terminologies of the option pricing, the most pertinent question now is how to find option value. The option value of an option at expiration is a function of stock price and the exercise price. In case of call, this payoff equal to stock price minus the strike price, and otherwise is true for the put option value. That would be the striking price minus the stock price. Generally, there are two payoffs between the time of issuing or purchasing of the option until the time of expiration. In case of the call option, payoff pattern at time 0 for the one who purchasing the call option is negative. It's less than 0 because he or she is paying option price. However, this difference, the stock price minus the exercise price equal to 0 or greater than 0 at the expiration of the call option time. On other hand, one who writes or issues the call option, the initial cash flow is positive, but the later on, before the expiration date, if the call option is exercised, it is always exercised when the option is in the money. Okay. In the money means for call, the stock price minus the exercise price is greater than 0. However, for the put option, the exercise minus stock prices is greater than 0. Then we are in the money. Whereas we are out of the money when for call the stock minus exercise price is less than 0. For the put option, when the exercise minus stock prices is less than 0, then we are out of the money. However, we are at the money when both strike price or exercise price equal to the stock price. In the following example, where we are looking at the option value given on an exercise price of $60. Call option is only valuable when the exercise price is being crossed, means stock price exceeds the exercise price by $10 when the stock price is 70, by $20 when the stock price is 80, by $30 when the stock price is 90. In that way, we get call value of $10, $20, and $30. However, the put option is available when the stock price is less than the exercise price. And so when the stock price is of $40, which is a less than $20 less than the exercise price, so put value is $20. On when the stock price is $50, the put value become the 10. The visual explanation of this example will be seen in the next two slides when we show you the diagram of these payoffs for both call option and the put option. Graphical depiction of call option value with exercise price of $60. The graph is plotted with x-axis showing the share price and the y-axis showing the call option value in terms of dollars. On the x-axis is an inflection point where 60 is written. It's the exercise price point. Soon after that, as price of stock increases, let's say $70, the payoff is increasing, and at this price of a stock, the difference between the stock price and $60 striking price is $50, and that is the call option value. Similar to the call option value graphical depiction, we can also show the payoff of the call option through this graphical depiction here. If the price of underlying asset, that is the stock in this case, its price is greater than the strike price, then the option will be exercised, otherwise it will expire worthless. The price of the underlying asset in this case is $50, and that is less than the strike price, so the owner of the put option will exercise the option and sell the stock at the stock price, and claiming the difference between the strike price and the market value of asset, that is $50, is a gross profit, and that in this case is the $10.
Another important insight worth remembering is option value cannot be negative. It is because an option is only a choice, it's not an obligation. The value of an option cannot be negative because you do not have to do anything to get rid of it. Option will always have a zero or a positive value. The options were around here with us for hundreds of years. However, the pricing of these options was a complicated subject, and it was until 1973 when the Marin Scholes and the Fisher Blake first published a path-breaking paper, the pricing formula for pricing the options. To understand it, we need to take into account the fair market. Securities or combination of securities with the same payoff is in varying scenarios should carry the same value. It can be understood with the two strategies. First strategy is of buying the stock with price P naught. Second strategy is about buying one call option on the same stock and investing in the risk-free investment, which will be providing the cash flows similar to strike price S in period T. So strike price will be discounted at the risk-free rate at period T, would produce the same payoffs regardless of how price turns out to be in period T. We can understand it with the example. If P not equal to 70 and S equal to 50 was your strike price, under this strategy 1, PT itself would be the payoff, whereas in under strategy 2, the payoff would equal to price at time T minus a strike price, that is 70 minus 50, and you'll get the $20 payoff from the call option. But the $50 strike price from your risk-free rate investment will be added to the 20, and you'll get the 70, which would be equal to the former strategy. So to be very fair, the present value of the strategy, stock option strategy, equal to option sub C, that is the option value, plus the present value of strike price discounted at risk-free rate at time T. In case of where option is in the money, which means striking price is less than the current share price in the market, then the value of the call option can be represented by the expression there, O sub C, that is call option value, equal to the present stock price minus the present value of striking prices, where the discount rate is the risk-free rate. So for the compounding concerns, if you are continuously compounding, this term of present value of exercise price would be equivalent to the strike price times e power minus risk-free rate. The above formula is not generalized yet, since it covers only the case where the option will be in the money. In other words, if option will be finished in the money with certainty. At this point, one can tell already that there are 4 factors which affect call option value, naming current value of the stock price P naught, the exercise price S or EX, the risk-free rate RF, and the time to expiration.